Welcome to this explainer. Today, we're diving headfirst into the complex and, yes, sometimes pretty frustrating web of U.S. tax law. As we go through this source material together, our goal is to figure out exactly how to legally and strategically maximize a retirement nest egg. Because, saving for the future isn't just about stashing money under a mattress. It's about putting it in the right vehicles at the exact right time. So let's jump right in and figure out how to actually make the tax code work for you. To avoid cognitive overload, here's our mental map for today's explainer. We'll hit employer plans, traditional versus Roth accounts, deferred compensation for executives, individual retirement accounts, and finally, self-employed retirement options. So let's start with the big one. How are you going to fund your future? At its core, saving for retirement requires a pretty tough trade-off. You're giving up cash today to get benefits way down the line. But as the data from our sources clearly shows, relying solely on government-promised benefits, like Social Security, can be a massive, costly mistake. You really have to take control of your own financial destiny.
To ground all these abstract tax concepts in reality, we're going to follow three specific personas straight out of the source material. We've got Tina, a brand new grad sitting in the 12 to 22% tax bracket. Then there's Carla, a high-earning mid-career CFO in the 32% bracket. And finally, Jason, our 74-year-old retiree navigating the 35% bracket. By watching how these three make their moves, we're going to learn exactly how to make ours.
All right, Section 1, Employer Plans. Let's check in with Tina, who just graduated and is looking at her very first benefits package at Corporate Business Associates. Historically, she would have seen a massive difference in her options. Employers used to offer defined benefit plans, your classic pension. With those, the employer promises a fixed payout and takes on all the investment risk. But today, the dominant path is defined contribution plans, like a 401k. The employer only defines what goes in up front, and the risk shifts entirely to the employee. If the market tanks, well, that's on you. Because pensions are basically disappearing, mastering the 401k is absolutely essential. And honestly, this heartbreaking reality is exactly why that mastery is so critical. Look at this quote from Vanguard's 2023 report. Almost a third of employees are leaving free money on the table by missing out on their employer's matching contributions. 31%. If your employer is literally offering to hand you money, you have to find a way to take it. Why is that so crucial? Because of this number right here, 100%. If your company offers a dollar-for-dollar match on your contributions, that's an immediate, zero-risk, 100% return on your investment. You are not going to find a guaranteed return like that anywhere else in the financial world. You put in a buck, they put in a buck. It's practically magic. So, obviously, you want that match. But there is a catch. To legally keep that matched money, you've got to stay with the company long enough to vest. Employers typically use a 3-year cliff, where you get 0 if you leave before year 3, but 100% if you stay, or they might use a 6-year graded schedule, where you slowly unlock chunks of that money over time. Your own contributions, those are always yours, but the employer's money, that requires a little loyalty. Moving on to Section 2, Traditional versus Roth accounts. Now that Tina has secured her employer match, she faces a really crucial binary choice for her 401k, traditional or Roth. The essential difference between these two is entirely about tax timing. With a traditional 401k, your contributions are deducted from your taxable income right now, saving you taxes today, but you'll pay ordinary income taxes on every single dollar you withdraw in retirement. The Roth 401k flips that completely. You pay taxes on your money today, but your future qualified distributions, and yeah, that includes all the growth, are completely tax-free. Let's actually look at the math for Tina. Because she's in a 22% marginal tax rate, if she wants to put $2,400 into a Roth 401k, it costs her exactly $2,400 out of pocket. But with a traditional 401k, because she gets that tax deduction today, her effective cost to get that same $2,400 invested drops to just $1,872. The general rule of thumb here? If you think your tax rate is higher now than it will be in retirement, lean traditional. If you're young and in a low bracket like Tina, lean Roth. Section 3, Deferred Compensation for Executives. Let's fast forward mid-career to Carla, our newly promoted CFO. Because Carla's income is so high, she maxes out her standard 401k in no time. Enter the Non-Qualified Deferred Compensation Plan, or NQDC. This is an agreement where Carla can defer a big chunk of her salary, say up to 10%, into the future. The beauty of this is that she dodges her current brutal 32% tax rate and pushes that income to a retirement year where her tax rate will likely be way lower.
But looking deeper into our source material, we find some real hidden dangers. This isn't a protected 401k. The massive risk here is that these deferred funds aren't set aside in some untouchable trust. The employer is just promising to pay you later. So if Carla's company mismanages their finances and goes bankrupt, Carla just becomes an unsecured creditor. She could literally lose all of that deferred compensation. It's a high reward, but definitely high risk tax maneuver.
Okay, Section 4, Individual Retirement Accounts, or IRAs. So what if you don't even have an employer plan? Or what if you just want to supplement your savings beyond those workplace limits? That's where IRAs come in. And the real-world timeline of PayPal founder Peter Thiel shows just how insane they can be. In 1999, he legally placed a tiny $1,700 investment into a Roth IRA to buy early shares of his company. Because it's a Roth, all the growth is tax-free. By 2002, it hit $28.5 million, and by 2021, an estimated $5 billion. When he eventually withdraws that money, the IRS won't see a single cent. It's just a staggering example of the tax-free power of the Roth IRA. Now, I know what you might be thinking. I make way too much money to contribute to a Roth IRA. Well, high earners are typically phased out by the tax code, sure, but there is a completely legal workaround: the backdoor Roth. Step 1, you contribute post-tax money to a traditional IRA, which has no income limits. Step 2, you immediately roll that over into a Roth IRA, paying taxes on any small earnings. And Step 3, you bypass the income limits and enjoy that sweet tax-free growth. For high earners, this is an absolute game changer. Let's shift gears and look at the end of the journey. When can Jason, our 74-year-old retired CFO, actually access and spend his money? He's built this massive nest egg, but now he has to carefully navigate the tax finish line. See, the government gave Jason tax breaks for decades while he was saving, but eventually they want their revenue. So they impose what are called required minimum distributions, or RMDs. These are mandatory withdrawals from traditional retirement accounts that, under current law, have to begin by April 1st of the year after you turn 73. You can't just leave those traditional funds growing tax-deferred forever. And the absolute key here is that you must monitor these RMDs like a hawk. Why? Just look at this penalty. If Jason forgets or fails to take his timely required distribution, the IRS hits him with a massive 25% penalty on the exact amount he was supposed to withdraw. That is an incredibly steep price for a simple clerical error. Conversely, that penalty punch applies on the other end of the timeline too. If you get impatient and withdraw funds way too early, specifically before age 59 and a half, the IRS will hit you with a 10% penalty, and that's on top of your normal income taxes. The tax code heavily enforces patience and proper timing. Finally, Section 5, Self-Employed Retirement Options. We've talked a lot about corporate employees, but the tax code provides incredibly powerful tools for gig workers, entrepreneurs, and small business owners too. First up, the SEP IRA. It allows for massive contributions, up to $69,000. But there's a huge catch. If you have employees, you must fund their accounts at the exact same percentage you fund your own. Then there's the individual 401k, often called a solo 401k. This is strictly for sole proprietors with 0 employees. It's honestly the ultimate tax shelter because it lets you make contributions as both the employer and the employee. This means you can max out your personal limits incredibly fast, plus make extra catch-up contributions if you're over 50. We've covered so much ground today, from employer matches to the backdoor Roth, right through to solo 401ks. The U.S. tax code really does provide the roadmap. But whether you build a standard, adequate nest egg or a tax-free, multi-billion-dollar golden egg like Peter Thiel, well, that depends entirely on your strategy. You've got the knowledge now. The tools are right there on the table. So what's going to be your next move? Thanks for joining me today for this explainer, and I'll see you next time.